Good afternoon, everyone, and welcome to B&M Care's funding webinar in association with SOLLA Accredited Financial Advisors, Eldercare Solutions. My name is Angela Hunt, and I am the Sales and Marketing Director for B&M Care Homes. A warm welcome to our existing families joining the webinar today, and also welcome to those of you out there stepping into the world of accessing long-term care for your loved ones and wading through the minefield that is finding ways to fund that care. At B&M Care, we've been operating care homes for over 50 years now, and we take the view that providers like us have a real responsibility to share our knowledge with our families as well as the wider community. So today's webinar is part of a series of our discovery events that we deliver, which includes things like the Dementia Awareness webinar and the Virtual Dementia Tour. You can go back and visit our website, bmcare.co.uk/events for any of the other upcoming dates. So let's move on to today's event. I'm going to hand you over now to Nicky from Eldercare Solutions, who is going to take you through today's care home funding webinar. Nicky, over to you.
Thanks ever so much, Angela. I'm just going to share my screen. Hopefully that works. I always get a bit nervous at this point that it doesn't, but it should do. Slideshow, there we go. Hopefully that's visible. Thumbs up from Angela. You can disappear if it's marvellous. Brilliant. Thank you very much for the introduction. So good afternoon to everybody. And just to make sure you are on the right event, our care funding webinar. So obviously with this being a webinar, you do not need to worry about turning on or off cameras or mics. None of that's going to work. So you won't inadvertently put yourself on the screen. The event is also being recorded and you will get a copy of that recording sent out either this afternoon or Monday latest. That just means that you don't have to scribble notes. You can go back over something that perhaps I've had to whiz through too quickly. You can pass it on perhaps to family members or any friends, neighbours, etc. in a similar situation, maybe needing this information. So do share the link far and wide. That's no problem. Just to make sure that you are on that right event and you're going to get your questions answered. I'm going to just share the planned agenda, which should run for about 55 minutes, something like that. I've picked this slide, by the way, that image, because obviously everybody watching today is going to be at a different stage of their journey. So some of you may be hearing information, certainly at the start of this, that you already know, but I do have to start from a position of no knowledge, because certain people might be at the very beginning where they could be finding everything very bewildering, very confusing, very unclear. Certainly that was our experience as a family when we went on this journey. So what I'm going to try and do in this relatively short period of time for a big topic is answer the question, who actually pays for a stay in a care home? I mean, it's a very simple question, but it does have quite a complicated answer. We'll have a look at where we stand with the lifetime cap on care costs that you may remember many governments mentioning over the last decade or so. I think if you were to Google this, there is some out-of-date information out there. So I want to make sure everyone is clear on where we stand with that. We'll look at whether the family home has to be sold to pay for a stay in a care home, whether there are alternatives that might be appropriate. And then in closing, and certainly for the people who have already navigated quite a lot of the care journey, maybe this will be the most key part really, is how to, in crude terms, make sure somebody's money doesn't run out. So if they are paying for care themselves, how can we actually stop it running out? How might we be able to protect legacies that people want for their money to be left for beneficiaries? So throughout the presentation, our website address is displayed, so you can grab a note of that, because that's a really good way to contact us. But I will make sure you do have a telephone number and an email at the end as well, or obviously just go back through Angela, who can put you in touch with us. So before I start tackling that agenda, let me just give you a bit more of insight really into who we are so you understand where we fit, why we do this. So we are, as Angela said, a firm of SOLLA accredited independent financial advisors. SOLLA, if you don't know of that organisation, it's a voluntary process that we as advisors put ourselves up for to be accredited, to be scrutinised, if you like. And there are only a couple of hundred, not a couple of 100,000, a couple of hundred SOLLA accredited advisors in the whole of the UK. So finding us is tricky in the first place. And even if you manage to find us within the umbrella of later life advice, that means different things to different people. Later life advice could be taking your pension, how to unravel your pension fund. So some might argue later life advice is for people in their 60s and 70s. Where we sit in the later life arena is at the really the latest part of later life, in that we specialise solely, exclusively in solutions for care fees funding. So, for example, our average client age is going to be, late 80s, early 90s. So that's where we sit. So just finding a SOLLA accredited advisor is one thing. You then need to sort of refine within SOLLA and find people that just advise on care fees funding. And if I'm honest, Eldercare is the only firm in the UK that exclusively talks about care fees funding and doesn't get involved in any other strand of financial advice. So if you want a true specialist, that's what we do. The business was set up by me, it's my company, set up in 2007 as a result, as I alluded to with that road sign. We went on this journey with my grandparents and we got absolutely no advice. Now, I'm not blaming anyone. We didn't know what we didn't know. We didn't put our hand up and ask anybody, or do you know if we could find a solution to stop the money running out, for example. We just thought we had no choice but to sell the property, watch the money dwindle, which it did, and deal with the consequences when it ran out. So it's only really when I found out through my professional career many years later that there was a solution that no one told us about, that I got on my soapbox and haven't got off since. And we're fortunate with BM Care that they help us and give us a soapbox to stand on to tell people about it, because it's all about just getting the information to you so you can make informed choices that we weren't able to make. So we have no commercial link with BM Care or anybody else. We work with many care homes up and down the UK. This is just getting the right information to people who need it. We are having money conversations with people. So you would hope, and we are properly regulated. You can look us up on the Financial Conduct Authority Register, which, by the way, is where you should check for any organisation that you're talking to about money to make sure they're properly regulated. It's the regulation that protects you. If you deal with an unregulated company in any sphere of financial services, you will not be protected. Now, I am in Hertfordshire. Many of you will be in Hertfordshire because that's where B&M's head office is and many of their homes. But we actually can deal with you wherever you are in the country and have been able to do that even pre-COVID times when we got used to Zoom and Teams and FaceTime a bit more readily. The reason we have delivered our advice, if you like, at arm's length, is because it's complicated. We don't want anything getting lost in translation. These are big decisions families are making, and it is rare for all of the family members to be able to get together in the same room and for us all to be able to be present. So by having a telephone call that can be followed up with everything summarised in writing by email, for example, that can be passed from one family member to the other and nothing gets lost in translation. Really importantly, it also keeps our cost base down. So we can have any initial consultation with you over the phone or by email, etc., free of charge. If we were coming to see you, we might have to charge for that appointment time. It also means that we can carry out research of certain financial solutions for you, also at our expense, not yours. Just that's the way we've created the business. It's not a charity, but we can offer that free to make sure that we can help you with the right people for you. If you end up buying a financial product, a fee is built into the cost of that product, and that's how we get paid. But that's many steps down the road and might not apply in your case. So you can speak to us knowing that you won't be invoiced for that call. So back to the agenda, and again, apologise if you've already navigated this part of the journey, so it's for the benefit of those that haven't. When paying for a stay in a care home, you're funded by really one of three possible streams. You're either funded by the local authority, social services, or the council. It's actually all the same place. Why call it three different things? Who knows? Just to make it super complicated, but that's all the same place. You might be funded by our much loved National Health Service, or you are a self-funder, also known as a private fee payer. So if we take those one by one, people that know a little about local authority funding, if they know anything at all, will probably realise it's to do with how much money you have, crudely speaking. But it's important to note that there is a step that comes first before any conversations about money, and that is that you have to have your care needs assessed by the local authority. They have to work out where your care needs would best be met. And if they don't agree that your care needs would best be met in a care home, for example, they think you can stay at home with maybe some support, then there will be no conversation about them funding a care home place because they don't agree you need to be there. Now, it's quite a high statistic, actually. It's about 1 in 5 people who have their care needs assessed don't meet their local authority's eligibility criteria. So any funding conversations go no further. So that's an important entry point to the system, and it's important for a couple of other benefits that I'm going to talk about later. So you have to meet this eligibility criteria to open up any of the doors to funding. So after that's done, then the financial assessment is done. The financial assessment you might more readily recognise as being called the means test. And that is the bit that is ascertaining how much money you have. What's the magic figure? I'm sure you do all know this because it's not changed in over a decade. In England and Northern Ireland, the figure is £23,250. So, as I was saying, that's not changed for over 10 years. So it's really going back in real terms. It's devaluing. In Scotland, it's a bit more generous, but it's certainly not free care in Scotland, as the myth would have it. Where the capital limit is at its most generous is in Wales, where it's 50,000. And these limits are per person, so you can double if we're looking at a couple. In England, we also have a lower level. So between the two, the 23,250 and the lower level of 14,250, the difference is simply you still have to contribute a bit from your savings. When the savings reach 14,250, you don't have to contribute that bit anymore. In Wales, they don't have a lower limit, much more simple. If we now look at what counts towards that capital limit, well, it is pretty much everything. There are 3 exceptions that I think are worth a mention. The first one is if we are talking about a couple, you are assessed as individuals. So it is only the person going into the care home, not the person staying at home, who's assessed. That means if the spouse staying at home has lots of savings in their own name, they don't come into the equation. If you own a joint account as a couple, the local authority will look at half the value. But that's a sort of rolling situation. And so you don't want your half of the capital inadvertently being assessed. So it is absolutely advisable for the spouse staying at home to remove their 50%, don't mess with the percentages, but their 50%, take it out of the joint account and put it into something in their own name, and then everything they own is properly ring-fenced and out of the picture as far as any local authority assessment is concerned. If they leave it in a joint account, then it's a rolling 50%. It will by default get taken into account. So there's a really helpful Age UK fact sheet if you need clarification on that. And that's nothing, and we're not advising you to do anything you shouldn't. It's perfectly acceptable to take your half out of a joint account. Better still, if you're looking at sort of the future and planning ahead, actually there's an argument to just try and equalise everything anyway and hold it equally, but in your own names. The notion of having things jointly sometimes, backfires when it comes to care assessments. The property. This is also misunderstood. We have lots of families where there's a couple scenario who believe that the local authority will come back at a future date and claim money against that house when there's been a spouse living there. They can't do that. If there is a spouse or relative over 60 staying living in the property that the person moving into care has just left, that property value cannot be included in the means test, not now or in the future, unless the situation changes such as the spouse at home predeceasing the one in care, or the spouse at home going into care themselves, or the relative over 60 moving out, from the date of those events, then yes, the house value becomes part of the equation. But up until then, no, and it will never retrospectively be included. So it's really important to note. Okay, downsizing. Sometimes we have couples, one staying in the big family home doesn't want to live there, they want to move to somewhere smaller. Again, they just need to be aware that if they release any money from the house as a result of that move, half of it will be included in the means test all of a sudden. So we often say maybe move to somewhere smaller, but the same value, because then you're still protecting all of that money in bricks and mortar, if that's feasible to do, which sometimes it is, going from a big property into a modern apartment, but the modern apartment maybe being more city central or town central, it might be the case that it's smaller, more manageable, but the same value. So again, get advice bespoke from us if the property scenario is out of the ordinary, but just as a rule of thumb, be aware then that the property cannot be included if the spouse or relative over 60 lives there. And the other exemption, not quite so common, but common enough to be worth a mention, if somebody has investment bonds that include life insurance, so this will be a product that they would probably have to have had independent financial advice to take it out. You wouldn't normally be able to just sort of go and buy one off the internet. And why would you? You need advice for this sort of product because the value and the funds go up as well as down, that sort of thing. Investment bonds that include life insurance can't be included in the means test either. So do not rush to cash them in. You can choose to, but if you leave them where they are disregarded assets. Now, that's kind of the capital. In other words, everything else, your second property, your money under the bed, your premium bonds, your ISAs, your stocks and shares, any business assets, all of that is taken into account. And this is often overlooked. Income is assessed by the local authority as well. They don't simply say, oh, you've got less than 23,000, we'll pay. They expect you to contribute your income towards what they pay as well. Now, if you are in a couple, and one of you's going into care and has a private pension, you can pay half of that private pension back to the spouse at home, but pretty much all of your other income is taken into account and has to be given to the local authority. So in effect, subsidising what they're having to spend. So if they were to say, yeah, we'll fund you, we fund £700 a week, and I've just made that up, all local authorities have different amounts and they should assess the people individually for what they're going to spend on them. Let's say £700 is the figure they agree to pay, but the person has £300 a week coming in as a pension. They don't get to add the 300 to the 700 and have buying power of £1,000 a week. That's not how it works. The 300 goes to the local authority, so the 700 is actually only costing them 400. That's really important to be aware of if you're sort of planning ahead and thinking, oh, well, if the money runs out, we know the council will pay this and we can add mum's pension to that. No, you can't. You have to contribute mum's pension towards what the council will pay. You don't add it on top. Now, the local authorities will, of course, have a limit on what they'll pay, and that can cause problems if the care home that's been chosen is more expensive, which sort of brings me to the top-up situation, because local authorities, if they are funding somebody from outset, have to find a care home place that meets their needs, but that does not ask for a top-up. So there must always be at least one care home place that doesn't ask for a top up. If they give you a list and say, go and choose a home from that list, and you ring all the homes and they all want a top up, you have to go back to the local authority and say, where is the no top up option? You have to offer us one. Okay. If they offer that place no top up, but you don't like it and you want to choose somewhere else, that's fine. You can transfer the contribution across, but don't expect the local authority to pay any more than they would have paid the home that they have the contract with. That home, if it's more expensive, can ask for a third party top up. Okay, so that's one scenario where that's perfectly legitimate. The other time that a care home can absolutely ask for a third party top up is if somebody starts off as a self-funder, they start off paying for their own care, and then they run out of money. When this happens, normally you would expect the care home and the local authority to talk to each other. Maybe a best interests meeting happens, and you'd like to think that the care home and the local authority will come to an agreement on a mutually acceptable fee where no top-up is required. However, the variables here are what did the care home contract say? What conversations took place with the care home when you moved in? Did they say if the money runs out after X years, you'll have to pay a top up, or you won't have to pay a top up? And if this happens within maybe 6 months of moving in and the care home weren't aware, absolutely they have every right to ask for a top up. If, however, it happens, 4 or 5 years down the road and the contract isn't clear, then maybe it's something you perhaps have to delve into. We say be really clear on this at the beginning. Ask the question upon choosing a care home before a move-in happens so that you know where you stand, so there are no surprises. So that's a whistle-stop of our local authority funding system, our safety net system. It's been with us for decades. It's not going anywhere. There was talk of the 23,250 limit changing, but that's gone quiet. So that's what we have to work with for now. You may, however, in recent years have heard about a cap on care costs. And as I said to you, you could do a Google search and there would still be very out-of-date information on there. So this was first sort of mentioned and statute, the Care Act of 2014, explored how it would all work, and then it didn't happen. It was brought back onto the table a few years ago. A particular Prime Minister standing on the steps of Number 10, promising that catastrophic care costs are a thing of the past, and this cap on care costs would take that problem away. The monetary amount that was mentioned more recently was £86,000, which, if you just read the headline, made you think that if you just put £86,000 to one side for care, that would be sufficient. Now, going back to about a year, this time last year, maybe a bit further back, I would have spent the next 5-10 minutes explaining to you how this was going to work. Explaining to you, giving you the bad news that it isn't as it seems, and that actually it was only the local authority rate of funding that would count towards the cap, not what you might actually be spending on a self-funded care home place, that you still had to cover what they deemed board and lodgings costs. So it wasn't the full LA fee, it was the LA fee less a couple of £100. And that even when you reach the cap, which we worked out would take about 4 years on average, you would still have to cover the lion's share of the costs. So it really wasn't quite what it seemed, but it doesn't matter because the whole thing has now been cancelled. So if you are reading anything on websites or on the internet that says it's coming into play last month, it didn't happen. It's not happening. Of course, there's lots of talk in government about changes needed to the system, but this doesn't look to be one of them. So you can now forget about that. So we've got our local authority safety net. We have got potential funding from the NHS, but this will only be in a very small category of people. It will be linked directly to how poorly you are and your primary needs being healthcare rather than social or personal care. So obviously when we are in hospital, we don't get invoiced as we leave. Our primary reason for being there is because we have a healthcare need and we need registered nurses or doctors to support us and look after us. If we have those same care needs, but we're in a care home rather than a hospital, the NHS should still pay for it. That's the simplest way I can describe it. There's a very good Age UK fact sheet that explains it in a lot more detail than that. And of course, I've oversimplified it. But put it this way, if you are in a residential care home that is not providing nursing support, it is highly unlikely, nay impossible, that you would be getting NHS continuing healthcare. It would typically be only funded if you're in a nursing home. If you're in a nursing home but just needing a little bit of support, it's not your primary healthcare need, then the NHS will pay a bit towards your nursing costs. £254 a week goes directly to the care home. So this might be something that's not relevant certainly now, while perhaps your loved one's in a residential home. It might not be relevant for you, but it might be something that crops up in the future. So just have it in the back of the mind. It's not linked to how much money you've got. It doesn't matter what your wealth is. This is not means tested. It's all about your healthcare needs. If you are basically not poorly enough to get that NHS funding and you have too much money to get the local authority support, that's what puts you into the self-funding category. private fee paying category. And really the only positive I have for you, and it might be old news and not news at all, is that you can claim or continue to receive attendance allowance if you're self-funding in a care home. Now, some people have never heard of this, and certainly some people that have heard of it think it stops when you move into care. This is not the same as carer's allowance. Carer's allowance goes to the carer. Attendance allowance is for the person that needs the care. So it's two rates. You either get just under 74 a week or just over 110 a week, depending whether you need somebody to attend to you. That's the name, attendance allowance. So does someone need to attend to you just during the daytime or during the day and the night? It's a very long form. If you're not aware of it, you can go to our website, eldercaregroup.co.uk, bottom of the homepage. On the left-hand side, there's an icon that will take you directly to the Department of Work and Pensions page on attendance allowance, phone number, put a claim in. They give you a while to fill it in, but the date of your call is the date that the payment will be backdated to, as long as care has been needed for 6 months or more. This is tax-free money. Okay, you do have to fill in a long form to get it, but once you're getting it, it's tax-free, non-means tested, doesn't need to be declared on a tax return. So absolutely make sure you do claim that. The only other state benefit or state support, I suppose, is a better description. Not everybody's going to be in this category, but lots of people are, those that we would call in financial services terms, asset rich, cash poor, meaning there's a lot of money in the house, but not a lot of money perhaps in the bank. So for that category of people, if there isn't a spouse or relative over 60 that's staying living in the property, so it is a regarded asset, if there's such a word, it's not disregarded, then the local authority has to ignore the value of it for the first 12 weeks of moving into care on a permanent basis. And if they ignore the value of it, they disregard the property value for 12 weeks, and the other money is under 23,250, then you are paid for as if you were truly state funded. You're not, you're a self-funder, so this is where all the confusion arises, because you can choose your own care home under the 12-week disregard. You don't have to go to a care home that the local authority have contracts with, but the rules apply in that you still have to contribute your income towards what the local authority are paying during this 12 weeks. So if you've got high income, it's not going to look too attractive. You still have to meet their care criteria that I talked about right at the beginning. So if they don't think you need to be in the care home, they're not paying this. And they can restrict what they pay to their local authority rate. You may have chosen a care home costing, say, $1,500 a week, but if the council pay $700, that's all that's going to go towards the fees. And you, as I say, you've lost your income, that has to be given to the local authority. The care home, however, in that 12-week period can accept what they call a first party top up. You can top up from your own remaining 20,000. In all other situations, it's a third party that has to pay the top up. So again, get some advice around this if you want, because the local authority don't really seem to understand it very well anymore. Lots of misinformation coming out, lots of people not told about it. It's free money. You don't pay this back. Now, I talked at the beginning about, do you have to sell the family home to fund a stay in a care home? This 12-week disregard period was really designed, I suppose, to give you time to stop and think. But actually, if you stop and think and have to get it sold, you're not going to get it sold within 12 weeks, not in the current market. But stop and think, is this a property that we have to sell now? What about the option of renting it out? How does that look? How do the numbers work? It would make the money perhaps go further if we'd got some rental income. But you must remember the rental income has to be declared and tax paid on it. You may have periods where you don't have a tenant. You may have wear and tear and repair costs, those sorts of things. After 3 years, the property value is then subject to capital gains tax. Simply being a landlord might not suit everybody. So it's not for everyone, but sometimes people do that and say, yeah, you know, we could get net 15,000 extra a year in rent. That would help the money go longer, last longer. The problem with that for most people is, even if you take into account the rent, add it to the attendance allowance, add it to the pensions, it possibly still doesn't cover the care home fees. So then they're back into the, well, we'll have to sell then. And some people say to us, well, we could always release money from the house, equity release. And we have to say, you can't do that in this scenario. In fact, it's a terms and condition of an equity release loan that it usually has to be paid back when somebody moves into care. So if we have a scenario where the owner has already moved out, so empty property, not owner occupied, you will not get equity release on that. So then, well, okay, so we do have to sell. Is that what you're saying? No, I'm saying that there is an option. It is a type of equity release, but it's actually offered by the local authority. They call it a deferred payment agreement. We call it a deferred loan sometimes. This could work and enable you to retain the property so that it doesn't have to be sold to pay for care, with the caveat that you still got to pay the money back somehow. So most families then end up selling when their loved one dies to repay the loan. But the point is, if it's an absolute priority to keep that property in the family and not sell it during their loved one's lifetime, this could be the way to achieve it. So all local authorities have to offer this type of scheme. They can refuse it for certain situations. So if you already have an equity release loan or a mortgage on the property, they won't lend. They want first charge. If the property is low value, they won't get involved because they need to know that they're not going to immediately use up the equity. And if there's any structural problems, then they're not going to lend. Otherwise, they will charge interest and setting up fees, but it will be cheaper than any equity release mortgage you could have come across. You still need to meet the eligibility criteria. So if they don't think you need to be in care, they're not going to make the loan available. And your other assets have to be under the threshold. So you can only use this once your savings are under the limit. But it's something you could, it's fully self-fund for 6 months, then the capital hits 23,250, then you can ask for the loan. This can be used for the short term if it's just about where you want to take a while to clear it and to get it valued and to get it on the market and to get it sold. So you can use this for the short term, or you can use it because you want to get a long-term rental arranged. So for either. And the good news is the local authority can cover full fees. They do not have to restrict it to the local authority rate. And why would they? They're going to get the money back. That's the rationale. It follows on from the 12-week disregard, so it is not something that should be offered to you without the 12-week disregard first. Okay, so make sure you get the free money and then tip it over to a loan after that. But if you want to, we can't advise on local authority specific schemes. It's their scheme, it's their charges, their costs, their admin, but we can talk to you more holistically about whether it seems sensible to consider or whether it would be better just to get the property sold and have the money liquid available to do things with. So moving on really to self-funders more broadly. So this might be that the house is already sold. They've got wealth and investments that mean that they're going to be self-funding for some time. Here at Eldercare, we normally engage with families when they're choosing a care home. That's the natural place that we connect with families. And at that point, when they're looking around, one of their main concerns when they're talking to us is, well, I've looked at 3 care homes. They're all charging different fees. We don't know what we can afford. And you're kind of like, well, did they not tell you what the fees would be? Well, yeah, they told us the fees, but we don't have a crystal ball and we don't know how long our loved one will be in the care home. So we don't know how many weeks to multiply the fee by, which is absolutely fair enough, isn't it? And unless somebody's got a pretty huge pot of money where there is no danger of it running out, it's a worry for people. When they're doing this cash flow forecasting, they're also often forgetting that the income that a person has, that can be used to put towards the care home fees, of course, because the care home fees are pretty much an all-inclusive. So they're not having to pay for food and utilities on top. So suddenly, just doing that cash flow forecasting, factoring in the income, that in itself will make the savings last longer on paper. But it doesn't detract from the fact that no matter how much money you've got, if somebody lives in care for many years, then the money could run out, and that is a worry for people. We certainly see, for example, just in the B&M newsletters over the years, where there used to just be a couple of residents whose 100th birthdays were celebrated, and now there's many. So people absolutely can live in good care for many years. Their life expectancy can go up when they move into care. They've got the social interaction, good meals, medication taken on time. All those factors mean that actually somebody can live well in care for many, many years. So this is, of course, a worry, a huge worry. And we here at Eldercare are just trying where we can to take those worries away. Now, we can't do it all the time. We're not magicians. If we talk to a family and they only have enough money to fund care for a year, maybe 2 years, there's nothing we're going to be able to put in place or suggest to them that will stop that money running out. We can guide them what they need to do when the money runs out. We can suggest that they have a very open and frank conversation with the care provider, so the care provider knows that this might happen and can talk about how that would work, but we can't stop the money running out. If, however, somebody has enough money, when you factor in their income as well, to fund fees for upwards of 2.5 to 3 years, roughly, then it's worth considering the solution that I'm going to spend the last 10 minutes, 15 minutes outlining to you. And it's a solution that 85% roughly of self-funding families never get to hear about. And we as a family were in this 85%. And this is why I do what I do, to try and get as many people out of the 85% as possible and into the minority who know about it. Now, once you know about it, it might be of no interest. Once you know about it, it might not even be affordable. So it might not be an option. But at least if you know about it, you can consider it. You can make an informed decision. We as a family were in the dark about it and found out too late. So I'm going to share with you now what I wish we had known as a family back then, and we would have made a very different choice to the way that we funded my grandparents' care. And it is a way of capping costs and putting a limit on what the cost of care will be, and taking action, I suppose, a bit like many other walks of life. I'm not saying that this is right, but in the same way that you can opt out of state schooling and go private, or you can opt out of the NHS and have private medical insurance, this is a similar concept, I guess. It's making sure that you do not have to ask for local authority funding at any point in the future, and you have provision yourself, and so you don't have those worries. Now, I'm going to call it insurance to start with, because everybody understands what insurance is, although some people hate it. And maybe it's not the best place to start, but insurance as a concept, we understand that. However, normally with insurance, you have to do it before the event. So you would have to buy car insurance before there's an accident. You'd have to insure the house before there's a flood. With care home fees, you can insure them, but you can't do it ahead of time. You used to be able to. You did used to be able to buy a pre-funded long-term care insurance policy, and if you do have one, it's still valid, but you can't buy one anymore. You haven't been able to buy one for over 10 years, maybe even longer than that, basically because the insurance companies, when people claimed, they claimed early and they claimed for a long time, so it just didn't work for the insurance companies. But what we do have is a product called a care fees annuity. And again, the word annuity is not a brilliant word, because people confuse that quite often with a pension or a retirement annuity. So the technical term, as I say, if you're going to Google, is to Google care fees annuity. But when you do that, it brings up pension calculators. So I just want to be clear, this is not the same. If it brings up Canada Life and all those sorts of companies for pension rates, that's not what we're talking about here. It's a similar thing. We're talking about paying a one-off lump sum, giving it to an insurance company, and we're talking about getting an income for life from it. But obviously with a pension fund, which might look really significant, you've saved into this fund all your working life, when you hand it over to buy an income, which is what an annuity is, it's an income, the insurance company is looking at you thinking, well, you're in your 60s, you're in good health, I could be paying out for 30 years. Oh, and you want a spouse's pension. Oh, and you want to keep pace with inflation. Well, you might have £1 million, but the income I'm going to give you is only 50,000. So of course you're going to look at that and think that's terrible value. But with a care fees annuity, these are individually underwritten, and they take into account somebody's age, which is likely to be maybe in the 80s or 90s. My oldest client to date is a gentleman, 103, who bought a policy for him and his wife, who's 104, did all of the admin, did all of it himself, nobody supporting him. He did have family, but he was perfectly capable of making these decisions himself. So it can be people in their hundreds, but the average client age is 89, and everybody's individual medication, care needs is taken into account. So it's a bespoke price for that individual. So when somebody says, What does one of these cost? Well, it depends. It really does depend. So you have to go through the underwriting process to get a bespoke quote. We can give indications of cost because we do this all the time. So we collect data of all the quotes that we've obtained over the last couple of years, categorized by age, so we can at least give you a ballpark figure so you can decide if it's worth researching or not. So our job is to be that sort of go compare the meerkat. You know, we take all the information from the family. It's normally the son or daughter or niece or nephew or occasionally a solicitor that's acting as power of attorney for the person in care. We collect some information in a 15, 20-minute telephone call. It's not anything more onerous than that. And with that information, we can give a guide price. If the family think, well, yeah, if it were that sort of figure or around about that, it would be worth finding out more, then we'll suggest you get the quotes and we'll do that for you. So we fill in a form, we go off to the whole of market, to all the insurance companies that offer these products, and we get quotes that take into account the individual's age and state of health. They don't involve the person. This is all done by either a request for a medical report from the GP that they pay for, the insurance companies pay for, or in most cases, they're able to get everything they need from a telephone interview with the care home, and they share that information amongst themselves. So it really is important to get all quotes because we never know who's going to be the cheapest, but we do that for you. Once we've got the quotes, we put it into a report that's really easy to understand, that's been built based on families' questions over the last 20 years. So we'd like to think all questions are answered within it. Things like, if I bought one of these policies and my mum moves care homes, does it move with her? Yes, it does. What about care home fee increases? We know they'll go up. Can I make provision for that? Yes, you don't have to. You can cover fee increases from the capital that's left over, or you can build it into the policy and we'll get you quotes with them without. Now, these policies are not investments. They're a gamble. They're a gamble around somebody's life expectancy. But I have to say that the alternative, of which there is only one alternative, which is to pay as you go, be that from taking money from investments or selling a property and using the proceeds. If you've got a lump sum of money wherever it is and you're drawing down upon it to pay the care fees, pay as you go, that does carry risk if the person lives a long time. There's very few cases we ever come across that there is no way the money could run out. For most people, it might run out if the individual lives in care a long time. So that carries a risk. It carries the risk of, will the local authority step in or won't they? How much will they pay? Will the care home take what they offer? So there's an uncertainty and risk if you do the traditional pay-as-you-go route that 85% of people are doing, probably because they don't know there's an alternative rather than it being their informed choice. But if you went the annuity route, that carries risk as well. If the person lives longer than the insurance company calculated, that's the insurance company's problem. They have to pay for life. If the person dies much sooner than the insurance company predicted, then the estate may well take a financial loss. Okay, and we understand that risk, and we appreciate that for some families it's a big risk. So we also get quotes to protect some of the capital. You'll still make a loss, but it will reduce the amount of money that could be lost. But of course, that comes at a price. The smarter way to capital protect is to buy these annuities with a delayed start date. So you still buy it now, but you ask the insurer not to pay out for the first year or not to pay out for 2 years. And for each year that you defer the start date, the price goes down by about a year's worth of income. So you end up at broadly the same place as you would have done with the immediate plan that you pay for all up front. But if the person died early, because you've paid less money to the insurance company, the estate loses less. So you still make a loss, but it's a smaller loss. So that's the best way to do capital protection. And we are very good at explaining this. We make sure we get all the options and do the number crunching to see which is the optimum deferred period, and we will give you that advice. I can tell you 100%, most advisors don't. We often get asked to sense check advice that's been given, and sometimes we get a copy of the application form, and invariably the advisor has just ticked no to getting the deferred options. They don't even offer it to customers, which I think is not good. So you will have all advice from us clearly explained in this report. We also just reassure you, for example, that these are covered by the Financial Services Compensation Scheme. No 85,000 limit, you're fully protected 100% of the income. So you get that report, no charge, you discuss it as a family, ask us any questions, anything you need to have clarified, and you should be able to make a decision from there. Now, this is a case study, a real case study, change the name, not the real photograph. I was dealing with this client's daughter in the main, but it's a fairly typical example, I would say, of where this can work as a solution. So this lady was 88. She'd been living independently in her own home, but that was no longer possible because she'd had a stroke. She had spent some time building up a bit of a relationship with a care home near her. They sort of did events, a bit like B&M do, and she'd gone along to a couple, and she really had got to know some of the staff and liked the feel of the home, and said, if I ever need to go to a care home, that's the one I would like to move into. But now we're at actually the point of having to move. She got a little unsettled about the affordability. Her daughter, who I was dealing with as power of attorney, shared with me also that what mum really wanted was to leave some money for the grandchildren and some money to the charities. So we really ideally wanted a solution that she could do both. She could have peace of mind that the care home was affordable for however long she was going to live there, and that she could leave some money to the grandchildren and the charities. They, like most people, as I say, were in that 85% where they didn't know they had an alternative. So I sort of mooted the idea of the care fees annuity, asked her to share some financial information with me, which in summary was that the care home they were looking at, which was maybe a bit further out, a bit further north, was 1,200 a week. They had income of 15,000. Mrs. Evans had income, her pensions and attendance allowance, that they hadn't realised, oh yeah, of course she can put that towards the fees. We don't need it for anything. So it took the shortfall down. It took the funding gap to 47,400. Now her situation was that she had enough money in the bank to pay for that first year. And they'd already decided they wanted to sell the property because they didn't want to be landlords and have to evict tenants if and when mum died, etc. So they'd already got it on the market. So she's not going to get any 12-week disregard support or deferred loan because she's over the 23,000 with her cash, and there's no rush to sell because, as I say, she's got enough money for a year. Her total assets are 300. So if we looked at that as a sort of graph format, what we'd see is that would the money run out? Well, yeah, if she lives 6 years, that's the answer. We don't know if she's going to live 6 years, but we know that if she does, that money's all gone. And that was the concern. So what we did was we'd mentioned the care annuity. We offered to get quotes. We did get quotes. We wrote the report, gave them all the advice, had a chat. Now, the next slide, please forget the figures because they're different for everybody. So please don't quote back and say, well, I saw that one of these annuities would cost this. It did for this family in their very specific set of circumstances. They were able to spend 165,000, so just over half the estate value, once the property was sold, to cover that shortfall for life. That remaining 45%, unless her care needs changed dramatically, and it's usually because you sort of need nursing care, in which case the NHS might bridge the gap or pay for all of it. So unless something really left field happens, 45% of that estate is protected, which is more than enough that she wanted to leave to the charities and the grandchildren. And as I say, before stumbling across us through the care home, she would never have known, the family would never have known about this, and they would have continued to worry for Mrs. Evans' entire stay in the care home. So what that looks like graphically is very different. You see a big dent in the savings to start with, but you know that all things being equal, it's flatlining from there. If anything, if she doesn't need to sort of take any personal expenses out of that money that's left over, you could even see the line start to go back up again. Now, it is possible sometimes to combine the pay-as-you-go and the annuity, but you have to do that really with caution, because if you're going to take some of the shortfall from savings and investments and then buy an annuity to cover part of the shortfall, we have to make sure the investments never run out. Because if the investments run out, we have put somebody in a terrible position where they do not have enough money to meet the care fees, and they won't get any local authority support because the local authority will include the annuity income when they do the calculations, and they'll likely say you've already got more money coming in than we would pay for you, so we're not paying anything. So we would make sure that situation never arose, that we never put a client in that position. A less experienced advisor might not realise that. I've watched complaints with the ombudsman, and one totally correct complaint was that somebody said, "Oh, spend the money on the annuity. It doesn't quite do the job. It doesn't quite plug the gap, but you could go and get local authority funding for that little bit that's missing." Not realising that the annuity income would be taken into account and your clients now spent all their money. So point being, talk to a specialist like us. Please don't go to a general IFA who may be brilliant at mortgages and brilliant at pensions and fantastic at business advice, but never really got involved with care funding. Just hopefully they will tell you to steer clear of them. But if they don't, please steer clear of them. These are the sorts of pitfalls that can happen. So this family, it should be evident, they were buying to ring fence the remaining assets. It was almost a byproduct, but a welcome byproduct, that they were never going to need to approach the local authority in years to come and do that battle. They weren't going to miss out on any NHS funding that mum might be eligible for in the future. She'll still get that. It just means the annuity income is surplus to requirement, so that goes into Mrs. Evans' bank account instead. She doesn't lose it. She will have to pay a little bit of tax on it if it goes into her bank account, because they're the rules. If it goes straight to the care home, it's tax-free. If it goes to the individual, it's taxable, but it's only on a little bit of it. The insurance company works out how much is return of your own money and how much is interest, and it's just the interest that's taxed. So it is a much, much lower rate than you might think. As I said earlier, we won't charge for researching this option. We just don't feel very good about invoicing people for something that might turn out to be unaffordable, or invoicing them for something that they say they don't want because it just doesn't stack up. So it means we're doing some pro bono work, but we are paid a fee if a purchase is made, and because we're specialists and because we do lots and lots of this business, we write 20% of the UK's care annuity business. So if you like, the business model allows us to offer those free consultations, free research. We don't want it to be a barrier. We know we'll be remunerated properly if a purchase is made. And the fee that is built into these quotes might be higher than some IFAs might charge, but if you're not being told about the deferred option, if they take months to get you quotes because they don't really understand the process, you'll make up that difference in price, I can assure you. We also, because we write 20% of the UK's business, have excellent relationships with the insurers, and we're often able to negotiate discounts for our clients. We have to act in the client's best interests. We're not working for the insurance companies. So we absolutely will get the best price for you that we can. These are the 4 insurance companies that offer care annuities. There is a 5th that I am talking to at the moment, a little under wraps, but hopefully their product will come out early next year. Legal and General and National Friendly worked with us exclusively to take their products to market. So this is what I mean by us being really top of the game. I don't like to boast, but we are very, very good at what we do and highly regarded. To be picked by 2 of the 4 insurers, and the only reason we weren't picked by the other 2 was because we didn't exist. Their products were already out there when I started the business, but we work very closely. All of these companies know us very, very well, and we will be able to get the best prices for you. If you're going to think about getting quotes and you want to, you've got in the back of your head, we have to shop around. Everybody says we must shop around. Shop around, absolutely, but shop around to choose an advisor and then just choose one, because they're going to the same 4 companies. That's not really going to benefit you. And in actual fact, the process gets a bit murky if there's 2 advisors on the case. Only one of them can get updates. And actually, if we're second on a case, we usually refuse to act because we don't want to go at that advisor's time frame. We want to be on this, getting quotes for you as quickly as possible. We want to be the lead advisor, controlling everything and getting the updates for you. So I would say pick the advisor, do your due diligence there, and then just stick with the one. Make sure that they are as a first SOLLA accredited. Don't even bother with anyone that's not, would be my strong guidance. Make sure that you can easily find the company on the FCA register, so you know which company you're dealing with and it's not owned by another company that you didn't realise were in the frame. And most importantly, look for client reviews. We collect ours on Trustpilot. I would say make sure the reviews are about care annuities, not mortgages, not investments, not pensions. They might be brilliant at all of those things. You want reviews about how was the care funding advice? How was the care annuity purchase process for you. Get that information from independent client reviews. That would be my guidance. I think, again, also, you can spot a specialist advisor quite quickly by looking at their website. So when you tap in eldercaregroup.co.uk, everything on there is about care funding. Most other advisors, it might be a little subsection of all the other things that they do. So it's just the difference between going to a GP or going to a specialist. Okay, so that's the best parallel I can draw. So there is our website. It's slightly changed, actually. I need to update this because we had a bit of a remake, but the principle is still the same, that if you are thinking about the care annuity and maybe want to talk to family about it, but really haven't got a clue how much this is going to cost, you can get a rough idea by going onto our website and clicking the button for the care annuity quote. It's not asking you to put in lots of information. It's asking you to give the age, the care home fee amount, and the amount of income that the individual has to put towards it. And just using those 3 pieces of information, it will give you an estimated ballpark cost based on the quotes that we've obtained over the years for people of the same age. Yes, it will change if you go through the underwriting process, of course. It might become cheaper, it might become more expensive, but the average price is a good place to start, just to give you a feel for it. If you then want to go through the underwriting process, just literally drop us a line, advice@eldercaregroup.co.uk, give us a ring in office hours, or drop us a note through the website. That's probably the best thing to do. And we will never waste anyone's time. If we think the annuity is going to be too expensive, we're not going to suggest you go through the underwriting process and get your hopes up. If it's borderline, then we'll say you've got nothing to lose by finding out. Let's just be certain. And if we think it's affordable, then absolutely, we'd always recommend you go through and get the quotes, because why not? You'll have a helpful document to then share with the family, and you can make a more informed decision than maybe applies to your current funding strategy. So just hoping that has covered everything. Thinking back to the agenda, we've now made sure we understand who pays for care, how the state funding system works, the safety net. The lifetime care doesn't exist, that the NHS might sometimes pay for you, otherwise you're a self-funder. But if you are self-funding, you've got the attendance allowance to claim. You may get some help for the first 12 weeks. You could access a loan if you really didn't want to sell the property now or in the imminent few years. And that you are no longer in the 85% of people who are pay as you go because they don't know any different. You know that there is at least an alternative that could be worth exploring. So I hope that that has met your expectations, and that there aren't big areas that you were hoping I'd cover that I haven't. If that is the case, drop us a line and I'm sure we can speak offline and answer your questions. But thank you so much for your attention. As I say, the event has been recorded, so as soon as that is available, I'll send over to Angela, who will of course pass it on to you as soon as she can. So enjoy your weekends, everybody. Thanks for your attention.